Hi everyone, in this second video lecture we are going to explore how to use predicted price changes to decide how much to buy or sell. Last time we looked at how machine learning can be used to build a model predicting price changes. Once that model is properly trained and tested on historical price data, it should be able to forecast or predict future price movements. And by the way, in the upcoming videos we will take a closer look at what it really means to train and test model the right way. So how do we actually use those forecasts or predictions? It's pretty straightforward in theory. If the prediction is positive, then we probably should expect the price to go up during the forecast period. In that case, we would probably buy at the start of the period and sell at the end. If the prediction is negative, it's probably the other way around. Sell at the start, buy at the end. And in both cases we make a profit, of course, if our predictions are accurate enough. Now, here's the thing, this simple approach might sound good and reasonable in theory, but in practice it is a little too naive. And if you are not careful enough, it can land you in trouble or worse, cost you money. So in this lecture we are going to walk through the right way to generate and use predictions. But before we can do that, we need to answer two key questions. First, what exactly are our predictions? Sure, it's just a number, but what does that number actually mean? Second, what is our goal? Sure, we want to earn money, but what exactly are we trying to achieve or optimize when deciding how much to buy or sell based on available predictions? Let's start with the first question, what does this prediction number actually represent? To answer this question, we will work with a synthetic dataset. In the first cell, we import the getSynthData function from the helper function.py file. If you are curious about how the dataset is generated, you can check that file, it's also uploaded to GitHub. In the second cell, we call this function with a single argument, the number of data points. It returns two objects, a 1D array of features and a 1D array of targets. This is a very simple dataset with just one feature. In cell 3 and 4, we print the first 5 features and the first 5 targets. Finally, in cell 5, we plot targets versus features. Now let's look more closely how a predictive model is built. We will use a linear function to predict the targets. That means we are modeling the targets as a straight line function of the feature. Our goal is to find a line that matches the data as closely as possible. To do that, we need a way to measure accuracy, a metric that tells us which line is better. To demonstrate how to define a measure of accuracy, we will use a pandas data frame so that we can display the data as a human-readable table. In cell 6, we create a table with two columns, feature and target, and display the first 5 rows. In cell 7, we take an arbitrary linear function with random values for the parameters k and c and use it to calculate predictions. We then add those predictions to the table as a new column named prediction. Now, how do we know if these predictions are good or bad? First, we calculate the difference between the target and the predictions. The difference can be negative, but overestimation and underestimation are equally bad, so we should remove the sign. One way to do it is to take the absolute value of the difference, which we store in the absolute diff column. Another way is to square the difference or multiply it by itself, which we store in the squared diff column. The first 3 rows of the resulting table are printed in cell 10. Finally, to turn these differences into a single accuracy number, we take the mean/average of the absolute differences and of the squared differences. This is done in cell 11. So now we have two different metrics or measures to evaluate a model. Next, let us see how these two measures relate to each other. For that, we generate a large dataset with 100,000 data points. Then, 10,000 times we do the following. Pick a random linear function with random values of parameters c and k. Calculate predictions using this function. Compute both metrics, mean absolute difference and mean squared difference. Keep track of the best model for each metric separately, saving parameters as c1, k1 for mean absolute difference and c2, k2 for mean squared difference. After 10,000 runs, we have 10,000 pairs of metrics. Now we can plot them, mean absolute difference on one axis and mean squared difference on the other. Each point on the figure represents one random linear function. Overall, we can see a trend. When one metric is smaller, the other tends to be smaller too, but the relationship is far from exact. If we minimize the mean absolute difference, we get one set of parameters corresponding to the leftmost point on the plot. If we minimize the mean squared difference, we get a different set of parameters, shown as the lowest point on the plot. Cells 15 and 16 show these optimal parameters, and as you can see, they are quite different. Now let's plot these two optimal lines. The red line is the model for minimizing mean absolute difference. The blue line is the model for minimizing mean squared difference. For this specific dataset, the lines are not just different, they are almost opposite. When the first model predicts positive values, the second predicts negative, and vice versa. So which predictions are correct? Which should you use for trading decisions? To answer that question, we need to talk about probability density distributions. For any given value of the features, the target is not just a fixed number. It is rather a probability distribution represented by a single number drawn from it. Changing the features' values changes that distribution, making some target values more or less likely. As I just said, the target you see in your dataset is just one random number drawn from that distribution. You can build a predictive model that, for any given value of features, outputs the full probability distribution instead of a single number. The figure below shows two different probability density functions. They differ in location, width, and shape. A higher value of the probability density indicates that the corresponding value is more likely to occur. For the red distribution, the peak probability density is about 0.2, while for the blue distribution it is around 1. The value 0.8 is relatively unlikely for both distributions, but it is more likely under the blue distribution than under the red one. Any distribution can be described by various parameters such as mean, median, dispersion, skewness, kurtosis, and others. Now that you understand the concept of probability density and its properties, you have the foundation needed to see why our two metrics behave differently. Minimizing absolute deviations gives you the median of the distribution, the point where 50% of outcomes are higher and 50 are lower. Minimizing squared deviations give you the mean or average. These two statements can be easily derived analytically, but we can also verify them numerically. To do that, we start with any arbitrary distribution, or in other words, a random number generator. In cell 49, we implement such a generator. We then use it to produce a set of random numbers. In cell 67, we vary x from the minimum value in our sample to the maximum in small increments. For each value of x, we calculate the mean absolute difference between x and the sample values and the mean squared difference. This allows us to empirically find one x that minimizes the mean absolute difference and other x that minimizes the mean squared difference. Now let us visualize the results. The figure below shows how the mean absolute difference, the red curve, and the mean squared difference, the blue curve, vary with the value of x. As you can see, each measure is minimized at a different value of x. We also mark the median of the sample with the red vertical line, and the mean of the sample with the blue vertical line. From the plot, it's clear that the median minimizes the mean absolute difference, and the mean or average minimizes the mean squared difference, exactly as we wanted to demonstrate. So once again, the meaning, or let's say the interpretation of your predictions depends entirely on the metric that you optimize during training. So now you know what your predictions actually are. If you minimized absolute deviations, your predictions should be interpreted as a feature-dependent estimates of the median of the target distribution. If you minimize squared deviations, your predictions should be interpreted as a feature-dependent estimates of the mean of the target distribution. Now that we know how to interpret our predictions, we are definitely in a better position to decide how to use them. So what can you do with the median? A median tells you there is a 50% chance the price change will be higher and a 50% chance it will be lower than the median. If the median is positive, you can conclude that the price increase is more likely than a decrease. But here's the problem: this alone isn't enough to decide how much to buy or sell. You have no information about how big the price change might be. Yes, you could win more frequently than you lose, but if the losing trades are large enough, they can wipe out all your gains. What about the mean? If your prediction is 1%, that means that over many trades with the same prediction, you would expect to earn on average 1%. Yes, sometimes the change might be plus 5%, sometimes minus 7, but if you repeat this enough times, it should average out to 1%. So if your goal is to maximize total profit, you would buy when the mean is positive and sell when it's negative. However, and this is very important, as you will see in later videos, maximizing total profit isn't always, or more precisely almost never, the best thing to do. So to wrap things up, when you build a predictive model with machine learning, a common approach is to optimize mean squared error, and in fact, most algorithms do this by default. Still, it's worth checking to be sure. Doing this will give you an estimate of the average price change for the period you are forecasting. If you are aiming for maximizing expected profit and trust your predictions, you could follow a simple rule. Buy when the predicted mean is positive, sell when it's negative. However, there are two big limitations to this approach. First, it ignores market volatility. Prices don't just drift smoothly, they swing, sometimes wildly, and ignoring that risk can be costly. Second, it ignores the confidence or accuracy of your predictions. A weak or uncertain forecast should be treated very differently from a highly confident one. That's why in the next video we will move beyond simple averages and explore the Sharpe ratio, a metric that balances return or profit against risk to make much smarter trading decisions. If you learned something, please hit the like button. If you have any questions, suggestions or requests, feel free to leave them in the comments. I will do my best to read and respond to each one. And don't forget to subscribe so you don't miss any new videos. Thank you.